The estate tax, known to many as the death tax or the inheritance tax. What is it and why do so many people have the wrong idea of what it is? Let's talk about it. Hey, I'm Kyle. I talk about money, and if you're new to this channel, hit that subscribe button and share this video. Before I begin, I'm not a tax expert, so all I'll be talking about will be overly simplified, but hopefully will give you a clear picture of what the estate tax is all about. I'll leave a bunch of resources down below. The estate tax is a political controversy, and depending on what party you lean towards, you might have your own opinions about it. But many politicians use it as a talking point. Some have called it the death tax, and some call it the inheritance tax. But in this video, I want to explain what this death tax actually is, so you have a better idea if it's a good thing or bad thing when it comes to your personal finances. Currently in the US, the estate tax is capped at $11.4 million. That means if you die, all of your assets minus your liabilities will be transferred to your designated heirs. If that total is less than $11.4 million, then that transfer of assets isn't taxed. Simple. Now, to keep up with inflation and sorts, that number increases year by year. Even better, if you're married, you and your spouse can shield twice as much at $22.8 million. And even better, if you die and your spouse survives you, your assets transferred to them will be tax-free. For the vast majority of Americans, the estate tax doesn't apply to them. Not many people have $11.4 million worth of assets. Many millionaires don't even have that many assets. This only affects the super wealthy. To give you an exact number, only 2,000 households in the US are subject to this tax. There are almost 130 million households, so you can see how small that number is. Now, if you do have over $11.4 million worth of assets, you don't get taxed on all of that. The tax rate is capped at 40%. Let's say your estate is worth $18 million and you die and your assets pass down to your children. The tax will only count towards any amount over $11.4 million. So in this case, only $6.6 million will be taxed. That initial $11.4 million is tax-free. You don't have to feel bad for those people. Although their lawyers and accountants have found ways to shelter their assets that trigger loopholes that will reduce their tax burden, it's still a hefty tax, but it can be reduced. To say this is fair, I have my own opinions on that, and if you have been following my channel long enough, you'll know my overall thinking on these things. But consider that one worked decades and decades to accumulate a fortune in excess of $11.4 million, or $22.8 million in most cases. How would you feel if nearly half of that is taxed? That's why there's a lot of backlash from this, because people who are rich don't like that, and people who want to be rich don't want half their wealth taxed if they get there. That's why proponents will call the estate tax the inheritance tax, since the benefit goes mainly to the children of the rich. And many detractors call it the death tax, because not even you dying can prevent the government from taking your money. All of this, I'm talking at the federal level. Some states enact their own estate tax separate from the federal government. And if you are a resident of that state and you have over the allotted amount, you can get taxed twice. I want to transition to something related to the estate tax, and that's the gift tax. The main difference are that the estate tax is activated when you die and when your assets are over the $11.4 million when they are transferred. The gift tax is a tax when the person is alive and when they are willingly transferring some or all of their assets to their heirs. The estate tax and the gift tax are two separate things, but they do affect each other. This is one way many of the wealthy can lower their estate tax by utilizing the gift tax, so let me explain. A gift tax is considered by the IRS as any transfer of cash or assets to someone else with no expectation of anything of value in return. So like, I give you $10,000 and I don't put any strings attached to it. That's considered a gift. It can be to anyone. Each American has what is called an annual gift tax exclusion. As of this video, it's at $15,000 per year. It doesn't increase as much as the estate tax year by year, but it does periodically. This $15,000 means you can give up to $15,000 as a gift, whether as cash, stock, whatever assets, to as many people as you want without having to notify the IRS. So let's say you have 50 close friends and you want to shower them with gifts. You can give each of them $15,000 every single year. Yes, this gift tax exclusion resets every year. So if you have 2 kids, you can gift them each $15,000 every year. Now, this doesn't matter for a spouse. Since you both are legally married, you can gift each other however amount, since it's technically both your money. You're not really transferring anything. Okay, but there's a catch to all this. If you give anything above $15,000 in a single year to a single person, let's say you give $20,000 to someone as a gift this year, you are required by the IRS to fill out a Form 709 to notify them that you went over your $15,000. So you gave $20,000. You put on the form you gave $5,000 over the allotted amount. Remember, this is per person. You can give 100 people $15,000 each and you won't have to notify the IRS. Only if you give over that $15,000 amount on a single person in a single year. The IRS wants this information because any amount you go over at the end of your life, they will add up all these Form 709s and deduct that from your estate tax amount of 11.4 million or whatever amount it'll be. It goes up every year. One way to reduce your estate tax burden is to gift your heirs as much as possible using this gifts tax. Let's say there's $30 million in assets you and your spouse have. Your estate tax limit would currently be $22.8 million. That means $7.2 million will be subject to the estate tax if you both die. To lower that burden, you can gift $15,000 to all your heirs. Let's say you have 5 children. So every single year you can give $15,000 each. That's lowering your potential estate tax by $75,000 every year. You can do this for your heirs for as long as they live. Even if you're 90 and your heirs are in their 50s, you can keep gifting them the limit amount until you get below that $22.8 million in assets. Of course, there are plenty of other ways to lower your estate tax. You can give a portion of all your estate to charity. That can help lower your estate tax. It's also something to think about just in case you find yourself in the super wealthy category. Now, for most of you, reaching that $11.4 million threshold is not going to happen. It's a lot of money, but if you do happen to make a fortune, the estate tax is waiting for you. That's a little bit of tax policy and something to consider. I tried to make this video as simple as possible so you have an idea of how your money works. That's something to think about. If you want to take care of your money, hit that subscribe button and turn on the notification bell so you stay up to date on when new videos come out. Don't forget to check out my other videos on business, personal finance, and investing. Until next time, I'm Kyle, and thanks for watching.